We're going to talk about the Federal Reserve's decision to leave short-term interest rates unchanged. As Mike tells us, the current rate remains above 5.25%. But Mike, everyone from home buyers to investors want to know when the cuts will begin. So let me introduce you. Mike Giordano, financial advisor with Williams Wealth Management, is here. I always feel like I say so much before you get the chance to talk.
You can talk the entire segment.
We have to set it up. No, they're here to see you. So first, you've said the real news on Fed days is not the immediate move, right? It's what the Fed signals going forward. Why is that?
Right. You're paying attention. I like this, Gabby. This is so good. Well, I mean, the Fed basically is like a parent trying to corral millions of children, the investors, right, the markets, everybody, the economy in general. And so what they don't want to do is they don't want to have any kind of shocks and surprises. They want to telegraph things in the future. I know my wife tells me all the time, don't just steal the iPad from the kids. Like, tell them you're going to take the iPad away, right? So the same thing here. If the Fed was going to cut rates today, they would have been signaling this for the last few weeks leading up to this. So what really mattered today was not what they said about what they were going to do today, but what they said they're going to do in the future.
All right, so tell me about the future. When did they signal those rate cuts might begin?
They don't know.
Yeah, great.
We can just end the segment. No, they don't know yet. They still believe they'll be able to cut rates this year. They still kind of project they're going to be able to cut rates 3 times this year. But when they're actually going to be able to start cutting rates is going to be more dictated based on inflation and how that plays out. The market still believes they're going to start cutting rates in June.
And let's talk about those inflation numbers because it seems to be getting stuck at around 3%. Is that making the Fed's job harder?
It could possibly. I mean, right now the Fed's been kind of dismissing the last couple of months of slightly higher inflation, saying that the general trend is that we're going to head lower. Now, the Fed does think that inflation may be a little stickier for the next couple of years than they initially anticipated. But if inflation does keep ticking up a little bit, it will make the Fed's job harder. They will have to delay those rate cuts. But they're saying right now they don't really see that the trend is for higher. They just think it could be a little bit longer until they get back down to 2%.
All right, so let's end this with some advice from you. Of course, how should we make financial decisions today as we are waiting for the Fed to cut rates?
Yeah, so we want to look at this from both an investor standpoint and a borrowing standpoint. From an investment standpoint, you want to look out into the future. So it's nice that like cash has been generating 5.5% rates of return on money market funds, CDs, that type of stuff. But if the Fed starts cutting rates, then you'll start seeing those percentages, those interest rates go down with it. So that's where you want to start locking in maybe some higher rates for a couple of years out possibly. If you're on the borrowing side, you want to look more like today. You don't want to start buying a house, a car, a boat, saying, oh, I'm going to be able to afford it by the time rates get down to 4 or 5%, I'll just refinance. You want to make sure that whatever you're buying today, you can afford in today's interest rate environment because nobody knows when these rates are going to go down. Nobody knows what the direction is going to look like, how the path's going to go. So you want to make sure that when you're making a borrowing decision, you can afford the money today.
So still remain cautious.
You got to remain cautious, but the cautious is a good thing to remain, in life in general.
Yes, absolutely. Good to see you, Mike Giordano, financial advisor with Williams Wealth Management. Thank you so much. We'll be right back.